Broadly speaking, what's going to work?
Well, I think...
And what is working, perhaps more appropriately today?
I think there are two ways that the average investor should think of investing. One is, are you going to create a good strategic asset allocation mix that is a balanced portfolio that means that you're not going to go to the betting table and bet against active investors like me? Look, I'm scared of being wrong in the markets. It is not easy to win in the market. It is more difficult to win in the markets than to compete in the Olympics.
Hang on a second. You guys have an extraordinary track record of winning.
Yeah.
Is it harder to compete in the markets today than it has been since you founded Bridgewater?
No, I don't think so.
Really?
Not the way we do it. And the reason I'm saying not the way we do it is we don't take systematic biases. I think for a lot of people, they're systematically long everything, you know? And so we have a world in which when the world gets bad, it's bad for them. In 2008, it was great for us. I don't know, we had nearly 10% return in 2008. So we have the opportunity to go either way. We just may be wrong if we're wrong. So I'm so scared about being wrong that it has helped reduce my chances of being wrong because I'm so scared. I won't take bets that that I don't feel good about, and we diversify our portfolio, and that's how we got the track record. I was just commenting in terms of,
I see.
Let's say, you asked me about investors. So I'm trying to go back what an investor should do.
Well, and what you think is appropriate for your
here's
investors,
what
you guys are doing.
Well, I want to just convey to investors. I think in the average investor, most everybody, don't compete against pros like ourselves or other people. Don't making tactical asset allocation bets or moving around in the markets because you're probably going to lose. It's difficult for us.
Just buy beta for 15 basis points?
No, you have to have a balanced portfolio. In other words, think about how you're going to have a balanced portfolio. What you know is that asset class as a whole, over a period of time, are going to outperform cash. Okay, that's the most thing that you could be most comfortable with. If they don't, you have a depression. The only times that hasn't happened. But to know how to achieve a balanced portfolio, and that's a whole other subject I don't know that you want to go through. If you're talking about tactical bets, in other words, I can come on the show and I can say, I think this is good. But then what happens is if I come a month later and I then change my mind because something has happened, then I'm going to mislead people. So the tactical bets I don't think are going to be helpful. I would say that we're in an environment in which it's very important to have a well-diversified, and that'll include assets like, to some extent, maybe a little bit of gold in your portfolio. In other words, what could I tell investors? Try to achieve balance in various ways. That's a whole subject about how to do it. And also, I think that, gold, at 5% of your portfolio, 5 or 10% of your portfolio, under the circumstances, would be also a prudent thing to do. Prudence is the important thing to do. The reason I'm also referring to that is we have a situation where a debt is money. In other words, we have a fiat monetary system too. And so we're having problems as these central banks operate. And so think of it as another form of cash. And when cash now has 0 or 0% interest rates or less, think of it as one of those possibilities in terms of how do you create diversification?
Do you worry, Howard, because of the fact that we have negative interest rates, for example, because we've had and still have quantitative easing, that the old rules of the game don't apply any longer? And if they don't, what do you do?
Well, that's really one of the very most important questions. I wrote a memo 2 months ago called "This Time It's Different," and historically, the words "this time it's different" have been used by people to rationalize bullishness that didn't work out in the past and violations of the norms that prevailed in the past, like valuations and that kind of thing. But John Templeton said, 20% of the time it really is different. And nowadays you have the sense that it's going to be more than 20%. So I think things, you can't say that the old rules apply, and you can't say that in the absence of the old rules, you know exactly how this is going to come out. We are in a difficult period.
Everyone should be looking for red flags. Certainly anyone who has money at risk in the market.
Yeah.
Eventually, the prudent investor will stop putting money to work, and he or she will wait for prices to correct. What signals or red flags, if you will, Howard, are you looking for to know that that moment has arrived? What should we see?
You know, there are no. You have to watch all these trends, and in particular, you have to watch what I call pro-risk behavior. People who are putting assets into risky asset classes because they feel they have to.
We've just established that that's happening all over the place.
And that's what I was going to say. So if that's the warning sign, then
we're already there.
Then we're already there. So that can't be the warning sign, or that warning sign can be exceeded, which is really true. And the answer is, you know, you can't say it's time to get out. What you have to say is today, given the totality of everything we've been discussing and all the on one hand and on the other hand stuff, should you have more risk than usual or less for you? You know, I hope that every investor has a sense for what his or her normal risk posture should be. And the question is, today, should you have more risk or less risk? And I would say less. And that's different from saying it's time to get out, it's time to sell. But I do think...
We're not there yet in your mind.
Well, I don't know if we ever know that we're there. You know, this is the time to sell. Anybody who says it is probably talking through his hat and unlikely to be right. But I do think that I feel very comfortable in saying that this is a time to have less risk than normal in your portfolio for the reasons we discussed, and in particular that this is not a time to be aggressive.
Concept of the machine, how you got to that and how you developed it.
Well, you know, the same things happens over and over again. Anything that's happened economically, I learned happen over and over again. So let me just describe the machine. It's a very simple machine, I think. And it's the same for an individual. A country is nothing more than the collection of its individuals or its companies. And so there are three main factors. There's productivity, which produces income. You can spend, at the end of the day, what you earn. And what you earn is a function of your productivity. And for a country, it's the same as for individuals. You work hard, you're well educated. You know, you can be more productive if you work harder, or you can be more productive if you're more creative. And so that's that. Over a short period of time, you can spend an amount of money which is different from what you earn. And that's because we have debt.
No,
and so,
it's called children. Continue.
Okay, thank you. So we have debt cycles, and there are two major debt cycles. There's a short-term debt cycle, which we're used to, the business cycle, we call it that. You know, recession, Fed eases, and what they do is they increase the spread between the short-term interest rate, essentially, and the expected return of other assets. And as a result, money goes out into the system, money and credit goes out to the system, and what it does is it bids up prices. And so when we're bidding up first asset prices, then we make items that are cheaper because interest rates go down. So we have that business cycle that we're used to. And then when that cycle gets past a certain midpoint, usually in the cycle, there's a tightening of monetary policy as you get to the later part of the cycle. And then you start to have inflation, it becomes too tight, and you have the cycle go down. And that's the business cycle. We're all used to that. So when we look at every country, we can see where it is in that cycle. We're in the mid part of that cycle, and hence we're having the conversation that we're having about the Federal Reserve. And then there's a long-term debt cycle, because these cycles add up. And a long-term debt cycle, just imagine you start off with no debt. So low debt to GDP ratios, low debt to income ratios. You start off with no debt. Let's say you're earning $100,000 a year, and then you have no debt. That means you can borrow $10,000 a year because you have no debt. You're earning $100,000, you borrow $10,000, you could spend $110,000. Your spending is somebody else's income. They are earning more, and so they can spend more, and it becomes self-reinforcing until you get to the point where debts rise too much relative to the income, like a balance sheet. You can leverage up to a certain point. And the central bank, all central banks, are in the business of helping that cycle go along, so they lower interest rates. And as they lower those interest rates, and those interest rates then hit zero, we then come to a dilemma. We have the end of monetary policy as we traditionally have it, and as a result, you can't keep that cycle going. Then, when you have big spreads and you put liquidity in the system, that putting the liquidity, money, in other words, there's debt and there's money. So the difference between debt and money is money you have to pay back. Debt you have to pay back. You go into a store, you buy a suit, you pay with a credit card, you have to pay it back. Money, it settles the transaction. So what the central bank does is that it can't create credit in the same way because there's too much debt. So what they do is they put money in the system. And they put money in the system by buying financial assets. And when they buy bonds, then the seller of that bond takes the cash and they buy something else. And as a result of that, it causes the spreads to narrow. It causes asset prices to rise. And then that appreciation in the asset prices that we experience then creates a normal term structure of interest rates. So there are three equilibriums that we have longer term. First equilibrium is debt can't rise faster than your income for long. Second equilibrium is that the operating rate in the economy can't be too loose or too tight. Third equilibrium is that we have a term structure of a capital market structure. In other words, that cash is going to have a lower return than bonds, which is going to have a lower return than equities and so on. And there's an equilibrium that keeps working itself through that system. Monetary and fiscal policy are the tools.
This has been the longest bull market in history. Everybody knows it can't last forever. You've studied market cycles, and you've identified patterns in investor behavior at various stages of risk-taking, from indiscriminate buying to sell everything panics. Where are we now?
Well, after 10 or 11 years of economic and market gains, you can't say we're at the beginning. You can't say that we have bargain-priced assets which are languishing. The truth is that, especially with the low interest rates, institutional investors who need significant returns are pursuing risk assets aggressively and alternative assets. They have to. So I think that most assets have been bid up and are selling at prices above their intrinsic values. Most markets are full of capital and somewhat crowded. I don't think we're in a bubble. I don't think conditions are crazy, but I do think that we're in the advanced stages of a very positive cycle.
It's hard to spot a bubble, isn't it?
I don't think it really is terribly hard to spot a bubble. There are certain forms of behavior which characterize bubbles. Now, that doesn't mean it's going to, if you correctly say we're in a bubble today, that doesn't mean it's going to be punctured tomorrow, because things can inflate further. But I think that, I've been doing this now 50 years, and I've lived through some bubbles, and I believe I've seen some bubble behavior. For example, almost every bubble, I guess, is characterized by people saying about a certain asset class or asset, there's no price too high. And I saw it in the Nifty 50 years ago, and I saw it in the techs 20 years ago. For a XYZ, the merits are so strong that there's no price too high. And clearly that's irrational.